This is Nightly Business Report with Tyler Matheson and Sue Herrera.
Not over yet. Stocks sell off again. This time, the Dow plunges 1,000 points, its second biggest point drop ever.
Staying focused, what to do and not do when the markets throw a hissy fit.
A House divided. Lawmakers are split as the deadline to keep the government up and running fast approaches. Those stories and more tonight on Nightly Business Report for Thursday, February 8th.
Good evening and welcome, I think. Okay, so you pick the description, folks. Swoon, slide, sell-off, throw in plunge, plummet. Any way you slice it, the stock market today was nasty again. For the second time this week, the Dow fell quadruple digits. This time, 1,000 points, a little more than that. Second biggest one-day point drop ever after Monday's fall. The Dow is currently on track for its worst week since October 2008. That was in the heart of the financial crisis. Now, the culprits today appear to have been the same that have dogged the market since last Friday: a rise in bond yields and sharp moves in volatility funds. Here are the numbers. Sit down for these. The Dow wilted 1,032 points to finish at 23,860. That is 4%. NASDAQ fell about 275 points, or 3.9%. And the S&P 500 dropped an even 100. Here's how far the indexes have fallen since their peak just back 10 days or so ago on January 26th. The Dow and S&P are both now in correction territory, and that means they are down more than 10% from their peak. And the NASDAQ, virtually there, off 9.7%. Pampazani has more on the day's action.
It was another wild day, the kind of day where the market appears to be changing by the minute. The Dow plummeted more than 1,000 points. It ended at session lows. Once again, in correction territory, down 10%. What is going on? The original trigger behind the sell-off was Friday's jobs report. Higher wage growth led to a spike in bond yields, and that spooked the stock market. That makes some sense. But since then, there's been a X factor, this stew of trading strategies, short volatility, long stocks trade, that's been unwinding. This selling that we're seeing this week, this massive selling, that's deleveraging, unwinding of those trades. For now, much of the selling appears to be professional traders, but if volatility continues, there will certainly be large outflows from retail investors, particularly those who poured an historic record $70 billion into exchange-traded funds in January. They're likely to get a little nervous. For Nightly Business Report, I'm Bob Pisani at the New York Stock Exchange.
As we mentioned, with the latest pullback, the Dow is now in correction territory, and the stocks in that index are some of the most widely held among investors. So is there any value to be found there? Here to discuss that is John Traynor. He's the Chief Investment Officer at People's United Wealth Management. We're also joined by Kimberly Forrest, who will give us her thoughts on today's market activity and what could be next. She is a Senior Portfolio Manager at Fort Pitt Capital Group. Welcome to both of you.
Thank you.
John, let me start with you. We mentioned that the Dow and the S&P are in correction territory. The NASDAQ is virtually there as well. Does this feel to you like a correction, or does it feel like a change in the market from bull to bear?
Well, I'd go with your first. We think this is a correction. And one of the points that we're trying to emphasize with clients is differentiating between what's going on Wall Street, which is shocking, and what's taking place on Main Street, really the real economy. And Wall Street is going through a correction, as you just said, a correction. There's some portfolio repositioning going on right now. We do not believe that that is going to leak over onto Main Street into the real economy. So long-term investors, keep your eye on the economy, and we think things there will be brighter skies to come. But there will absolutely be a transition, and the transition's not over. We see this volatility continuing.
Kimberly, how about you? How long could this spasm last?
That's a great question, and I have to tell you, no one knows. That being said, what we're going to do is look at how investors value stocks. And generally what they do is they look at the PE times a multiple, and we'll get to what that equation is here in a second. It's price divided by earnings times some multiple. And historically, when interest rates have been very, very low, investors have had to accept higher multiples. And last year, the market ended at about 20 times the price to earnings ratio of the index. And this year, that's falling, and that's falling because of bond prices. So what we have to ask ourselves is, how low does this have to go for investors to be happy with the multiple? And I think we're close to it. We're down again about 10%. And, it feels like this could be a bottom. But again, no one knows what is in the future for anything, let alone stock prices.
John, you gave us some buying opportunities, for longer term investors. A lot of we had a parabolic move up in the market, and it feels good when the market goes up like that. It doesn't feel so good when the market goes down. But
no, it doesn't.
If you do have a long-term time horizon, what would you be buying right now? And if so, what?
Well, what you want to do is look at your highest conviction names. And for us, it was actually 3 of the stocks in the Dow. We like Home Depot, we like Disney, and we like United Healthcare. We think each one of them is going to be a beneficiary of a robust economy. They're beneficiaries of the tax reform that we've seen. And each of them has a unique business model where we're seeing strong earnings growth. So we're sticking with the highest conviction names. That's the kind of advice we're giving clients right now. Now is not the time to be bottom fishing in Bitcoin. We think the 3 names I mentioned would be better names.
Kim, John just gave us some good ideas there. Are you selectively buying these days, or what is your posture?
Well, we like to buy low and sell high because we're value investors. And I can't tell you exactly what we've done, but we would likely be more of a buyer than a seller at this point. There are a lot of good stocks out there that we believe are mispriced. And again, we're going towards those high quality names that are benefiting from an improving economy. And that would include names in the industrial area as well as technology, because productivity never really goes out of style.
John, you mentioned that you're talking to your clients. What are you hearing from your clients? Are they worried about this market? What are they asking you, and what are they telling you?
Well, yeah, that's a great question. And for most of last year, I sounded like a broken record. I was talking to them about, as rates rise, we anticipate seeing higher volatility in the market. We've actually been bringing to client meetings a chart that shows the last 3 Fed interest rate increase cycles. From start to finish, the S&P 500 was higher, but it was a very rough ride. Volatility increased. So last year, we didn't see the volatility. People were saying, okay, we hear you, but we don't see it. Now they're finally seeing it. They're seeing that volatility, and we're saying this will continue. We anticipate this kind of volatility continuing in the market. 2018,
Kim, is sure not 2017 in terms of anything right now in terms of volatility. We've given up a lot. Really almost half of 2017's gains in point terms, if you look at it that way. I wonder, even though the market is so heavily driven by algorithmic or machine trading, are there any telltales that could tell you that the bottom has been hit? Is there a number? Is there a data point? Is there a profit report that could kick in and turn the psychology?
Well, I think in the 18 years that I've been doing this is a cliche, but it's really true, that people are driven between the 2 poles of fear and greed. And I have to think that the beginning of this year was people were hovering around the greed pole, right? Because they saw that market going up so steeply, and everybody was piling in. Now, in a very short time, we've got that other pole, the fear pole coming up. So I think when you feel like the worst, that could be the time where it just stops because there's no more excess to get out of the system.
All right.
And I don't know when that is. Sorry.
No, that's okay. Listen, you don't have a crystal ball. Nobody does.
Nobody really does.
John Trainer with People's United Wealth Management, Kim Forrest with Fort Pitt Capital. Thank you both.
All right, the deadline to keep the government up and running is midnight tonight, and as of this evening, there are growing divisions, particularly among House lawmakers. Kayla Tausche is on Capitol Hill for us. Kayla, where do things stand as of now?
Well, Tyler, there have been no votes so far, and that deadline still looms in just a matter of hours. The House had always been eyeing a late night vote tonight, but the Senate had hoped to wrap up its vote by this afternoon. But there have been some obstacles, perhaps predictable ones, that leadership is now working to solve expeditiously.
What might those be? What were the holdups?
Well, in order to move forward in the Senate, Sue, all 100 senators unanimously need to sign off on a measure to move forward today. And there's one who is not on board. Senator Rand Paul vehemently opposes higher spending and debt levels, and throughout the day today has been trying to force a vote to get people to outlaw these new raises of budget caps to try to put Republicans on the record on this issue. So basically, he wants to fund the government, but not at the higher levels that the White House, the House, and the Senate have already agreed to. That's something that's not going to fly.
So if he holds all those cards and they've got to have 100% behind the vote, what is the risk now that the government shuts down again for the second time in a month's time?
Well, there is still an opportunity for this to get sorted out before the clock strikes midnight tonight. But without Senator Paul's support, the Senate can't move forward until the wee hours tomorrow morning, risking a technical shutdown where the government goes unfunded overnight, but then Congress scrambles to get a deal together before federal workers report for duty at 8 a.m. Unclear whether they could get a deal within that window of time, but that is certainly at this point a possibility. All
right, Kayla, we leave it there. Thanks for watching it out for us. Kayla Tausche on Capitol Hill.
And as Kayla mentioned, the budget agreement brings more spending, more debt, and potentially more problems. Elon Mui has that part of our story.
The Treasury Department projected to hit a milestone next year, but it's not one to celebrate. The nation's deficit is forecast to top $1 trillion in 2019 after lawmakers in Washington struck a deal to keep the government open. Experts say that compromise paves the way for a big increase in federal spending, adding nearly $2 trillion in deficits over the next decade. More borrowing means bigger interest payments at exactly the time the Federal Reserve is raising interest rates.
Overspending truly is a bipartisan problem. Republicans and Democrats both, it doesn't matter. Once they're in charge, they start spending as fast as they can. And this deal is absolutely the best example of that.
Even before this budget deal, interest expense was on track to become one of the biggest costs in the federal budget within the next 10 years, right behind Social Security and Medicare. By 2048, it's expected to be the single biggest category of federal spending, according to the Peterson Foundation. This is not the way Republicans intended to run the government when they took control of Washington a year ago.
This is the president's FY 2018 budget.
The White House was very proud of the fact that its first budget actually balanced over the decade and reduced the national debt in year one. But all that appears to be falling by the wayside now, and some fiscal hawks aren't happy about it.
At some point, we're going to have to change the name of the Department of Treasury to the Department of the Debt, because there isn't any treasure left over there.
But the reality of deal making here in D.C. is that more money is often the solution to the thorniest political problems. For Nightly Business Report, I'm Elon Mui in Washington.
And let's take a look at some of today's upgrades and downgrades. Why not? Humana upgraded to outperform from neutral at Credit Suisse following the insurer's earnings report. The firm expects its enrollment growth to continue. The price target there raised to $306 a share from $259. The rating on Boston Beer was lifted to neutral from underperform at Macquarie. The firm cites higher growth in products like Twisted Tea, which investors like you could probably use some of after today. The price target there raised to $189 from $155. Boston Beer shares up 1% on a really bad day. So that tells you people were out grabbing a beer.
Clorox was downgraded to hold from buy at Argus Research. That firm says margin pressure and private label competition would impede growth. The analyst also sees few near-term catalysts for the stock. Clorox shares finished down a fraction to $127.76. Twitter was downgraded to sell from hold at Pivotal Research after the company reported earnings this morning. The firm says Twitter won't be able to beat its stronger competitors in the ad market. The analyst reiterated his $21 price target. Despite the downgrade, the stock soared 12% to $30.18.
Courage of his convictions there. One reason why Twitter's stock was up so much was because it reported its first quarterly profit ever. Revenue also higher thanks to product updates and more ad sales. Julia Borsten now with a look at what's working for Twitter and the challenges that remain.
Twitter says changes to its timeline, more live content, and longer tweets are paying off. The company announced a surprise return to growth, growing its revenue 2% in the quarter and beat analysts' expectations on earnings as well. Twitter's monthly active users of 330 million fell short of expectations. That number flat with the prior quarter, though up 4% from a year earlier. But Twitter reported its fifth consecutive quarter of double-digit daily active user growth.
We're proud of the steady progress we made in 2017, and we're confident in our path ahead. We've got a significant opportunity ahead of us to put Twitter in as many people's hands as possible and to make the service more relevant to more people every single day.
CEO Jack Dorsey saying that 2018 will be an investment year for Twitter as they no longer focus on margin growth and focus on hiring more people on their product and sales teams. They'll also keep working on artificial intelligence to show users what they're most interested in, such as showcasing more live content and a new feature called Happening Now at the top of users' timelines. And analysts are encouraged that Twitter has plenty of room to grow.
The advantage that Twitter has, though, just from an ad dollars perspective, is the same one that Snap has. These companies are tiny. Snap is 1/100th the size of Google. Twitter is 1/50th the size of Google. So they can grow decently without even having to bump into those Goliaths, which are Facebook and Google.
As for concerns about bots or fake accounts on Twitter, which have drawn criticism for the manipulation of the presidential election, Dorsey says they're working on the, quote, information quality across the platform, trying to direct users to credible accounts and content. For Nightly Business Report, I'm Julia Borston in Los Angeles.
Up next, what CVS is doing with its tax reform windfall.
CVS Health is number 7 in the Fortune 500, a giant in a fast-changing industry, and it wants to get even bigger. It plans to buy the insurer Aetna. That's a big deal, and so were its earnings, which nearly doubled. Bertha Coombs takes a look at CVS's strategy.
CVS Health's quarterly results saw a $1.5 billion benefit from tax reform. Excluding the tax break, profits were driven by growth in the company's pharmacy benefits business, which offset continued weakness at its stores. CVS plans to take its tax windfall and plow it back into the business, putting a big chunk toward worker benefits. Starting pay will rise to $11 an hour from $9, matching competitors like Walmart, which also has a pharmacy business. And all full-time employees will now get 4 weeks parental leave. They'll spend on improving stores and boosting data systems as well, which the company believes will help it improve patient care as it looks to turn store clinics into health centers. The rest will be used to pay down debt as CVS tries to win regulatory approval for its $69 billion deal to buy health insurer Aetna. Last week, the Department of Justice extended the antitrust review period on the deal. On the company's earnings call, CEO Larry Merlo said that was expected.
Things are moving along as planned, and we continue to expect the transaction will close in the second half of 2018. In addition, the integration planning has begun, and we have assembled a team with representatives from both companies and are very pleased with how the planning process is progressing.
Executives say those investments will pay off longer term in an increasingly competitive healthcare environment, one CVS hopes to dominate even more. For Nightly Business Report, I'm Bertha Coombs in New York.
Viacom raises its full-year revenue forecast. That's where we begin tonight's Market Focus. The media company missed quarterly sales expectations, but said it's optimistic that its results will improve this year. The company said it's working to improve growth in advertising sales and cut back on losses in affiliate revenue. Last week, Viacom and CBS said that they were exploring a merger. Viacom shares rose 7% to $32.71. The New York Times reported another quarter that saw a decline in print sales, but the newspaper still topped expectations thanks to a growing digital subscriber base. Subscription revenue reached more than $1 billion, and that helped to bulk up overall sales. The company said it expects to see subscriber growth remain strong during this quarter. Shares popped 10% to $24.40. The drug maker Teva topped earnings expectations, but it gave a bleak outlook for the rest of the year as it faces regulatory issues with one of its new migraine treatments. The company said the FDA raised concerns with its drug manufacturer, calling into question when that medication might enter the market. Teva said it's making progress on its restructuring plan, but acknowledged that 2018 will be difficult. The shares fell 10% to $18.64. The clothing maker Hanes Brands reported a rise in quarterly sales but gave earnings guidance for the year that disappointed analysts. Profits during the period were in line with estimates, but shares of Hanes Brands fell about 11% to $19.57.
A growing user base helped the restaurant delivery platform Grubhub top profit and sales expectations. Grubhub also said Yum Brands is going to take a 3% stake in the company and partner with it to offer new delivery options across the country. Grubhub shares, look at them, up 27% today at $89.04. The beauty products maker Coty said strong demand for its newly acquired brands helped earnings top Wall Street's forecast. The company said it is optimistic about the year ahead, raising expectations, saying it expects to post positive revenue growth in the second half of 2018. Shares climbed 14% to $19.96. And after the bell, the insurance giant AIG missed profit expectations as tax changes and catastrophe losses hurt results. AIG shares initially rose slightly in the extended session, but they did end the regular day down 3% at 58.28. Also after the bell, the chipmaker NVIDIA reported earnings and revenue that easily topped forecasts. The company also gave sales guidance for fiscal 2019 that was stronger than expected. NVIDIA shares initially took off in after hours, but they did finish the regular day down nearly 5% at 217.52.
Coming up, how to stay focused on your long-term goals in a stomach-turning market.
There's a little bit of a rundown of some classic safe haven investments for a volatile market like this one. But if you own stocks and your stress level is rising, there are a few things to remember if you're a long-term investor. And Sharon Epperson is here to help you navigate the ups and downs.
Well, Tyler, you know, it has been a roller coaster ride that many never expected. The recent swings in the stock market have been especially tough for long-term investors who often buy and hold, but now they may have gotten a little spooked. So here are some tips on how to ride out this wild market. First of all, you know it, don't panic. Just remember your goals. There's a reason that you started investing. You set a goal. It could have been to save for college or fund your retirement. Whatever your plan, take a few deep breaths. I'm into yoga now, and stick to your plan. The money is there for the long haul, and then it's probably better to be in the market where over time it's going to grow. The next thing is don't hit the sell button until you've reassessed your risk. If you're losing sleep at night over the market turmoil, your investment mix may be too aggressive. After last year's gains, your portfolio may need some tweaking. Rebalance, diversify your holdings, and if you need cash for a large purchase in 2 or 3 years, rethink that stock exposure. And finally, don't go it alone. Talk to an advisor. Speaking with a pro who's weathered these kind of market moves before may give you a much-needed gut check. And it's their job, especially in times like these, to calm you down. And if you need it, to help you rework your investment strategy. Guys?
Thank you so much, Sharon. Before we go, here's another look at how the major indexes closed. The Dow plunged 1,032 points to close at 23,860. That's 4% to the downside. The Nasdaq fell about 275. The S&P 500 dropped 100. And here's how the indexes have fallen since their peak on January 26th. The Dow and S&P are in correction territory, which means they are down more than 10% from their peak. The Nasdaq is off more than 9%, actually closer to 10%, almost in correction territory. That will do it for us tonight. Thanks for joining us. I'm Sue Herrera.
Going to be an interesting Friday, folks. Thanks for being with us. I'm Tyler Matheson. Have a great evening, everyone. We'll see you tomorrow.